Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And yes, we have her back. This is Anna Kelly, and we are talking about inflation and deflation. How you doing this morning, Anna?
I'm doing great. So good to be back.
Yes, something I have been waiting to ask you is, because we've been doing this for a couple of years together. I just love how you kind of see the economy. You see the chessboard. We're both active in real estate. When you look out in the future, understanding where we are today, what do you see as a greater risk? Inflation or deflation? Because both, frankly, are possible. So what are you thinking?
So, one of the things that I always say is it really depends on your definition of inflation and your
Ah,
definition of inflation, right?
okay.
Of deflation. And so, inflation in prices generally results in deflation of the dollar or
Mm,
deflation in the purchasing power of the dollar.
hmm.
And you can try to mitigate inflation of costs one way, and you mitigate the devaluation of the dollar in another way. And so, sometimes when people just throw out, we're afraid of mass inflation. Well, what do they mean? They mean
Hmm.
inflation of prices. Most of the people that say we're really afraid of deflation, what they mean is they're afraid of the deflation of the dollar. And the
Mm,
reality is, when you have the deflation of the dollar and its purchasing power, you have essentially inflation of costs and a higher real cost of buying those same values. So you can have an inflationary cost of consumer price index at the same time that you have deflation of the dollar. And
hmm.
that's really what people are afraid of is going to happen right now. We're printing so much money, the government's printing so much money that there's so much artificial pent up demand
Hmm.
in the market, in housing, in steel and lumber and all kinds of goods and gasoline, et cetera.
Hmm.
And because of this pent up demand, supply is getting hammered. There's more demand than there is supply,
Yeah.
and that's causing prices to go up, which is inflation. So that's what most people are really afraid of and what we're experiencing a little bit of. Um, Inflation prices go up mean the value of your dollar is not going as far, and therefore your dollars have a deflationary impact.
Yeah, when I look at this, there's a couple of things. Again, I've been following the consumer for 30 years because every economist I know has their variable that they watch because the economy is so complex. There's all these things. If you try to watch them all, you'll just confuse
Yeah.
yourself. I've always chose to focus on the 68% of the economy that is the consumer. And when I break down the consumer, there's a couple of things to think about. First off, just daily life, which is gasoline, food, rent, mortgage,
Yes.
education, healthcare. All of that right now is without question going up.
Yes.
There are signs that some of that will be transitory, to use the Fed speak, right?
Yes.
Food, right? As food kind of unlocks it, the supply will grow, to better meet demand. Um, so I get that. I think that's right. But there's one sneaky variable that I want to throw out that I think is going to surprise people to the upside. And it's something we haven't seen in decades, really since the 70s. And that's wage inflation, right? The employee, right? I think the
Yeah.
employee has more power now than they ever had, right? Think about being a high school student today getting a job, right? They're getting 15, 16, 17 bucks an hour, which just awesome. So I see wage inflation being pretty sticky, which if it is, that will have all kinds of impact because again, that will affect rents very likely. And it's just how it works. So
Yes.
when you think about consumer inflation today, we'll stick to the goods. Do you see that mainly being transit? I mean, think gasoline, right? I'm in California. It's almost $5 a gallon again. It's not 3.30 like it was last year.
Yeah. I mean, typically speaking, consumer price index, this general basket of goods that households buy, has said to go up about three to 4% per year every year. Now,
Yeah.
granted, there's some variance, but the average is about 3 to 4%. And depending on what else you're looking at outside of just that basket of goods that's included in the CPI, some believe that inflation's been closer to 5 or 6%
Yeah.
for a very long time anyway,
Yeah.
right?
Because the CPI is such a managed number, right? They do switching
Yeah.
costs and it's just, yeah. Yeah.
It really is. But let's just say we take an average of 4% per year.
Okay.
We're typically we've been on that pace, right? Right now, I know the numbers keep coming out higher and higher. The Fed says we're going to keep interest rates low until inflation is at 2. Well, it came out at like 3 or 4, or very close to that.
Yeah, 3.9% was the PCE. Yeah.
Yeah, and it was really, really close to 4. And they said, but this is transitory. It's going to come back down. So we're not going to raise rates just yet, but give us another year and we probably will, right? So they see inflation. The question is, how much of it is just happening because of the pandemic, because of these supply issues, and how much of it is going to be more lasting? And that's really what the question is. So your comment about wages, I think, is a really important one, right? Because there's this real push in the government, especially on the Democratic side, who are in power right now, to bring us up to a standard living wage, which is about $43,000 a year. Somewhere in that range has been tossed out, which, oh, by the way, is what people got on unemployment when they got an extra $600 a week, right? So I know friends in multiple different businesses, entrepreneurs who have construction businesses, landscape businesses, and other businesses where they cannot get people to work for less than $20 an hour doing what should be a 10 to 12 hour dollar an hour job a year ago. And it's because people were able to make more on unemployment and flat out have told them, I could make more going and doing this. Or you have a lot of these centers, warehousing centers like Amazon, they're paying people $17 to $20 an hour to warehouse in an air conditioning building. People don't want to mow grass for less than $20 an hour. And so just the cost of standard things like getting your grass mowed, now people who have landscape companies are paying their employees that plus the cost of their healthcare and the taxes on top of it. You know, they're at $35 an hour for the cost of labor. So I think that is probably something that's going to be lasting, and even more so under our current government, where they push for higher wages. The only way businesses stay open is they raise the cost of all their goods to pay for it. And so the consumer ends up paying a lot more for all these things that have basically unskilled labor or uneducated labor doing what was an $8 an hour job for $20 an hour.
Yeah, it's I don't know, Econ 101, right? If you have to raise the cost basis, it's got to come somewhere. Yes, some businesses can squeeze profit margins. That's fair. But it ain't going to be the answer for all of it, right? If wages really get sticky. When I think about deflation, my world obviously as a real estate guy goes to assets, right? I think there's a lot of, I think the last year, don't bet against the Fed has been the right answer, right? Stocks, crypto, and housing. And one of the things I have to ask myself is, is there kind of asset inflation that could deflate, right? Could we see an adjustment? And if we are, where is it more likely, right? And it will be sudden and it will be violent if it happens in the stock market, without question. It's just that instantaneous environment. Like the taper tantrum, I think that was 2018. That was a sudden, was it like 12% move in a week or something? And then you got to think about housing. And I think housing is set up very different than last time. So these are things that I think about. So when I think deflation, I think assets. How about you?
Yeah. So, I think that in things that have had an artificial bump in demand over typical long-term demand, those prices are high because of that, supply chain issues or increased money that suddenly people can spend on things they didn't have before, like a first-time home when they haven't had to pay rent or they haven't had to pay mortgages, and now they can, get in with very little money down. People are looking for houses. And so I think those homes in that first-time home buyer price range have gone crazy in terms of values, with 20, 30 offers on a single house. I think that is probably not sustainable in a lot of markets. And unless it's in a market where, again, it all comes back to supply and demand. If it's in a market where there's significantly lower supply than the demand for the people that are coming there, the prices will stay high for a while until demand and supply has an equilibrium. It's those areas that already were pretty well supplied, and they're either at equilibrium before the pandemic, and now there's just this artificial bump in, demand over supply. I think those areas have more of a chance of kind of coming down in value and really just stabilizing. Not that they're going to crash or have mass deflation, but I think the prices start to stabilize in those areas where there's been this kind of artificial inflation of asset prices. I think they come down and stabilize a little. I don't think they crash. In terms of real estate,
Yeah.
stock market, I have a different opinion on. I
Yeah.
think we're due for a major correction. I don't think the prices are sustainable or make sense, but we'll see.
Yeah. Yeah. We're going to actually do an episode 4 here. We have time for it. We're going to do the housing slowdown. That is something I've been talking about pretty much the last 6 to 8 weeks, and it's setting up how we thought about it. So we'll close this one out. Anna, how can people follow you and be part of your world?
Sure, great. So here every week when I'm not on vacation, we do our recordings on Wednesdays. Also, you can find me on Anna REI Mom Kelly on Facebook or LinkedIn, and my website for investment opportunities where we make an impact on the lives of those who live in our communities, as well as trying to make strong returns for our investors. Find me there on greaterpurposecapital.com.
Go check it out, folks. You do yourself a favor. Thanks, Anna.
Thank you.